The U.S. government debt pile crossed $40 trillion last week, and rising bond yields are putting fresh pressure on Washington. U.S. Treasury Secretary Scott Bessent responded by doubling the Treasury planned buybacks of long-term bonds to $4 billion through November. The aim was to support prices of 10-year and 30-year Treasuries. The move initially pushed the 30-year yield down by 10 basis points, the biggest one-day drop in a year. But the yield quickly rebounded. That has raised questions about whether Treasury buybacks can address the bigger problem, the scale of U.S. government borrowing. The U.S. budget deficit is still close to 6% of GDP, well above Bessent's target of 3% by the year 2028. Interest payments are expected to equal about 3.3% of GDP this year, compared with a long-term average of around 2.1%. Higher yields mean higher borrowing costs for the U.S. government and can also push up mortgage rates, business loan costs, and government borrowing costs around the world. The pressure is not limited to the U.S. Bond yields. In Japan, Britain, and France have reached their highest levels since before the global financial crisis. The bigger concern is that the bond market could force governments to make tougher fiscal choices. Bessent is trying to buy time, but investors are also watching inflation, Federal Reserve policy, geopolitical risks, and the scale of future government borrowing. If investors demand even higher yields, governments may have to cut spending, raise taxes, or accept high inflation. And because U.S. Treasuries are a core asset in global finance, a sharp U.S. bond sell-off could spread to other markets. The central question now is whether Bessent can restore confidence or whether the bond market will force Washington to confront its debt problem.